affirmed a lower court decision which also rejected the Trump administration's legal explanation for imposing tariffs. As a reminder, Trump implemented tariffs under the International Emergency Economic Powers Act, which gives the president the ability to react to, quote, unusual and extraordinary threats. The new ruling states that the law does not, however, give the president the ability to, quote, impose tariffs, duties, or the like, or the power to tax. You may remember we did discuss this on a previous podcast episode when it was the U.S. Court of International Trade that made that ruling. Here's what we said a few months ago. The law literally says, this is only legal if it is in response to, quote, an unusual and extraordinary threat to America. And there was no unusual or extraordinary threat here. I mean, Trump said the threat was the trade deficit that we have with many other countries. But as people have said over and over, and as we've said, a trade deficit is completely normal. That's not a threat. So to call that the unusual and extraordinary threat, it just doesn't hold up. So this new ruling, which is coming from the appeals court, this confirms the tariffs are illegal. What does this all mean? Well, for now, it doesn't really mean anything, because the court has decided to let the tariff stay in place until this deadline of October 14th, which will give Trump time to appeal the decision again, which he's definitely going to do, but this time it will go to the Supreme Court. That is, of course, if the Supreme Court agrees to review the case. But this is such a big deal. This has such large implications for everyone that they almost certainly will. So lots of questions to answer. Our producer Claire spoke to David Gantz, professor at the University of Arizona's Rogers College of Law, to get his take on where things go from here.
I think it's a very difficult case because you're dealing with a statute that is extremely broad. The International Emergency Economic Powers Act essentially says presidents can regulate the importation of goods. It can deal with any unusual or extraordinary threat to the national security, foreign policy, or economy of the U.S. It does not say you can use tariffs, but it doesn't say you can't use tariffs either. So the judges have to struggle with how broad this delegation of power to the president actually is. And the majority says the authority was not broad enough to support these very broad tariffs on Canada, Mexico, and over 100 other countries, based on fentanyl and based on trade deficits with the world. My personal opinion is that the Supreme Court will essentially say the president has the authority to do what he did under the IEEPA. Many other lawyers disagree, so it's obviously including 7 of the justices on this Court of Appeals. But I think overall, it's a very vague statute. It's hard, I think, 50 or so years later, to say, well, this is what the Congress intended in terms of the narrowness or the breadth. It's not the only statute in the last 60 or 70 years where the Congress has delegated what many of us believe unconstitutionally, very broad powers over trade and tariffs when you think about the Commerce Clause and other actions that are reserved to Congress. In my view, it's unfortunate what the Congress has been doing for the last 70 or 80 years, but the fact is there is precedent, at least for the idea that Congress may delegate very broad authority to the president. Not just this president, but obviously all the others in the last 50 years.
I'd love to just get a bit more color on how you're thinking about the Supreme Court's decision, which is likely coming next. Do you feel that just because this is a Republican majority court, things are likely to go in Trump's favor? Or is it really that this whole thing is so vague that it'll be difficult for them to uphold this ruling?
In my personal view, it's some of both.
Okay.
I mean, I don't remember how many cases have gone forward in the last 6 months challenging Mr. Trump's authority to do one thing or another, mostly domestically. And I think in 19 out of 20, the court has said, yes, you can do this. So just on that basis alone, and the fact that he and his and the Republicans on the court have a huge 6-3 majority, I think it's very likely, again, many disagree with me. I think it's likely that they will find a basis, perhaps in the dissent, to say to Mr. Trump, yes, you can go ahead with the tariffs on this basis. I think, from a legal point of view, it is complicated by the very vagueness of the statute. You're talking about, regulating importation. Well, one of the ways you regulate importation is using tariffs, even if it's not mentioned, to deal with an unusual or extraordinary threat to the national security, foreign policy, or economy of the U.S. I think you would really argue that there's nothing unusual about the balance of payments problem. That's been around for decades. I think there's an argument that the fentanyl crisis, if it really exists, it does with Mexico, does it with China or Canada, I don't know. You could argue that the fentanyl crisis fits within that very broad group of considerations. So I don't think it's difficult for the Supreme Court, to say, we agree, it's covered.
Say the Supreme Court does uphold the ruling, what would that mean for these tariffs? Would these tariffs actually be rescinded? Would the U.S. have to repay those tariffs? What kind of recourse would we actually see?
Well, there are obviously a lot of questions in there that we can't really answer. There has been quite a discussion among legal experts, some of them more than I, as to whether all these tariffs would have to be repaid. I don't think this case should be read as much more than what the Trade Representative Jason Greer said a few days ago, and that is, it's a temporary blip in the use of the tariffs. Undoubtedly, there will be litigation over whether or not the tariffs have to be refunded. I have no idea which way the courts would go on that. But I think in the longer term, there are over 3 years left of the Trump administration. During all or almost all of that period, there will still be substantial tariffs being imposed on foreign imports from many, many, or if not most countries on various legal grounds. And if the IEEPA is thrown out, they will find other grounds to do what I think they want to do.
That was David Gantz, law professor at the University of Arizona. So it sounds like, according to Professor Gantz, these tariffs are here to stay. It sounds like basically Trump will do whatever he can to muscle these things through. But I think it's worth taking a moment to look at some of the quotes that we saw in the official ruling from the appeals court. There were a few moments that I think are telling of the legality of this situation. We'll see what the Supreme Court says about this. But just a few quotes that I want to emphasize here. This is on the precedent of this Emergency Economic Powers Act. Let me just read this quote to you. Quote, "Not once before has a president asserted his authority under IEEPA, that's the act, to impose tariffs on imports or adjust the rates thereof. Rather, presidents have typically invoked the Emergency Powers Act to restrict financial transactions with specific countries or entities that the president has determined pose an acute threat to the country's interests. For example, in the aftermath of the September 11th, 2001 terror attacks, President Bush invoked IEEPA to establish a process for designating terrorist organizations. In almost all other instances where the Emergency Powers Act has been invoked, presidents did so to freeze assets, block financial transfers, place embargoes, or impose targeted sanctions. The invocation to impose tariffs on nearly every country in the world is undoubtedly a significant departure from these previous invocations." So this goes back to the idea of what even constitutes an emergency. In every other instance, there has been a specific threat for which this Emergency Powers Act has been invoked in order to pursue a specific solution, i.e., we've just been attacked by terrorists. So let's sanction the regions that are specifically suspected of harboring those terrorists. But the idea of saying the world is screwing us, no one in particular, just, the world in general, so we're going to tariff the world. At a certain point, if that's your definition of an emergency, well, then the word starts to lose its meaning, and so too, therefore, does this act itself. Another great quote that I would draw your attention to. So first, the court is referencing Trump's argument, which is that the tariffs are a, quote, less extreme tool for achieving America's objectives. Put another way, the Trump argument is, look, these tariffs aren't that big of a deal. We're not launching bombs on people. We're just putting up these little tariffs. And so, that's covered in the Emergency Powers Act, not a huge deal. And in response, the court actually quotes James Madison, one of the founding fathers. This is from Federalist number 58. Quote, "The power of the purse is the most complete and effectual weapon with which any constitution can arm the immediate representatives of the people." End quote. So put another way, according to James Madison, you can't downplay the severity and the extremity of these tariffs as an excuse for doing them. In fact, as he said himself, it is the most powerful weapon we have. And so to strip that power away from Congress, away from the people who are supposed to represent us, and then put it in the hands of one guy, that is a step too far. They end that segment with another great quote from James Madison. This is from Federalist number 48. He said, quote, "Congress alone has access to the pockets of the people." And that, I think, is the crucial point here. When it comes to matters that concern, as he says, the pockets of the people, when it comes to an effective tariff rate of more than 15% on all of us, on all American consumers, it is a tax on the American people. It directly affects our pockets. When it comes to matters that concern that, you have to get the approval of your constituents. You can't just leave it to one person. And, maybe people would say, well, the people voted for this. Well, actually, we can look at the approval ratings on the tariffs right now. The approval rating, the number of people in America who say this is a good idea is 38%. The disapproval rating on tariffs right now is 61%. So that's more than 6 in 10 Americans who think that the tariffs at large are a bad idea. More than 200 million Americans. So we know where the American people stand right now. We know that the American people don't want this. And yet, here we have the commander-in-chief basically deciding, no, we're just going to blast this through. I'm going to use this loophole, this IEEPA, to just make it happen. And the American people won't have a say. And that is essentially what is at stake here. And that is what is going to be decided by the Supreme Court if they take the case. We'll see if they take the case. I'm sure they will. And we'll see if, according on Friday. For years, this rule let overseas sellers ship items under $800 duty-free to the US with minimal inspection. But back in May, Trump ended the exemption for all goods from China and Hong Kong. And then in late July, he expanded the rollback to include all countries. And now that is going into effect. Just a quick reminder on this de minimis loophole, the history behind it. So the term de minimis actually comes from Latin. It basically means too small to matter. And that was the idea behind this exemption. It was created in the 1930s. It was originally designed so that Americans could buy souvenirs. And the idea was that if the product is really cheap, well, then it doesn't really matter. You don't need to pay import taxes on that. But then, of course, as usually happens, companies started to exploit this loophole. And it went from being too small to matter to too big to ignore. And last year, America processed 1.5 billion de minimis shipments. That is 4 million packages per day, with most of those shipments coming out of China. Actually, the estimated share of packages that come from China of the de minimis packages, it is 60%. By the way, roughly half of that is estimated to come from 2 companies alone, and they are Shein, the fast fashion retailer, and Temu, essentially China's Amazon. Now, you probably know where I stand on this. As we've discussed before on the podcast, I'm pretty anti-Shein and pretty anti-Temu. These companies have been suspected, and in some cases, it's been proven that they rely on forced labor, that they rely on labor camps in Xinjiang. And that, by the way, would perfectly explain why their products are so cheap. And it would also follow that this de minimis loophole is essentially incentivizing that business model. I mean, by some estimates, Shein and Temu are saving $3 billion per year because of the de minimis loophole. So if the upside to using forced labor to produce crazy cheap products that you can ship at under $800, if the upside to that is $3 billion in savings, well, then it becomes just a little bit harder to not go through Xinjiang. So my view on this has always been, we should get rid of the loophole specifically for China, which Trump did. But now he is extending it to all countries. And that will have very different implications for our economy. So to tell us more about this, our producer Claire spoke with Amit Khandelwal, the Hahn Professor of Global Affairs and Economics at Yale. And he recently wrote a report that investigated specifically how shutting down this loophole could impact our economy.
Eliminating the de minimis exemption based on the analysis that we've done would find that lower income households in particular will be hit harder than richer households. And there's really two features of the data that pin that down. So the first is that it appears that lower income households disproportionately spend more as a share of their income on goods that enter through the de minimis channel. And then the second thing is, like, once you open up and try to figure out, well, where are these de minimis shipments coming from, whether they're purchased by richer households or poorer households, we find that poorer households or lower income households seem to be purchasing relatively more goods from China. And since China is the high tariff origin at the moment, it just means that if you eliminate the de minimis exemption, and now everyone faces tariffs, or all shipments face tariffs, it's going to look like a regressive tax in the sense that lower income households, they're going to see more of their shipments now taxed, and then even higher tax because they tend to buy them from Chinese goods, from China.
Right. So a regressive tax on poor people does not sound like a great direction to be moving in, but the two arguments that I hear in favor of closing the loophole are that many of the products entering the U.S. through this loophole have been found to come from forced labor. And then there's also President Trump's argument, which is that drugs might be entering the country through this loophole. What's your response to those arguments?
Yeah, so I think those are important points to be taken seriously. And I think the question that we want to think about from a policy design is the exemption the best way to address both of those two concerns? And so it may be that relatively more goods come in, illicit goods or goods made through forced labor are coming into the de minimis channel. And then the question is, if you eliminate the de minimis shipment, does that kind of directly target the problem at hand, or are we simply going to, illicit actors are going to move those goods through other formal channels and hide them in other ways? It's possible that they won't, but I think the way that we've tried to deal with that in the past is through stepped up enforcement and auditing of the channel. And so it's kind of like if you have 99% of goods that are coming in that are made kind of standard household goods made under proper working conditions, et cetera, and then 1% are really bad. I'm just making up those numbers. I don't actually know what the fraction is. Do we want to set up do we want to eliminate the de minimis exemption completely, or do we want to think about more direct targetings of those goods? And I think that's where, it's a little bit unclear to me that this would solve the problem. Which is a real problem to be solved, I would say. I think you need to be thinking about this policy as kind of two separate things. There's the de minimis exemption, which is trying to ease the burden of importing for both consumers as well as CBP to target their limited resources into the larger shipments. And then there's this separate issue of illegal products coming in. And I think, typically, if you have two problems, you want to use two kinds of policy instruments to deal with those problems.
That was Professor Amit Khandelwal of Yale University. His point is an important one. There is a big loser in all of this. There are many losers, but one of the biggest is, of course, low-income Americans who actually rely on these cheap imported goods more than anyone else. I mean, to go through the exact numbers here, the numbers from his research report, in rich zip codes, the percentage of shipments that are de minimis shipments is 52%. Compare that to poor zip codes in America, where it's 73%. So that's 3/4 of all shipments going into poor neighborhoods, they're de minimis. And the share of de minimis shipments from China also declines with income. It's 22% for the richest, 48% for the poorest. So by closing off this loophole, you are essentially adding on tariffs, adding on tax to most of the shipments that go to poor neighborhoods in America, which of course is only going to add fuel to the fire of inflation. And as we have discussed many times, these tariffs, I mean, they're going to hit one group harder than any other, and it's poor people. I mean, they are the ones who are going to suffer. Meanwhile, we could take a look at the winners here. There are winners, but it's basically two companies. It is Amazon and Walmart, because those are the next best options for cheap products behind Shein and behind Temu. And in fact, we are already starting to see perhaps some of the benefits of closing this loophole. Amazon sales increased 13% last quarter. That was an acceleration from 10% growth in Q1. So, the story here, at least when it comes to the consumer, is kind of the same as ever. Big corporations win, poor people probably lose. Now, having said that, that is the dynamic we are likely going to see. But there's this other issue where the consumer economy here appears to be so dependent on the forced labor of people in China. And I'm not exactly sure what to make of that. That's just not a great situation to be in. And to Professor Khandelwal's point, perhaps it just means we need a more targeted solution to that problem. Perhaps closing the loophole to the entire world is not the answer. Perhaps maybe we should have just stuck with China. I'm not sure. But the bottom line here for the consumer, the days of buying $4 sunglasses from Shenzhen with free shipping, the days of buying a $10 dress from Shein or a $10 hoodie off of Temu.
Issue of security hanging over the Chinese large language models, I think, to users in the West at least.
Yeah, I completely agree. And I think that we should watch the space. I think it's a matter of time before these LLMs get politicized in the same way that semiconductors have been. I actually think that is a likely outcome. The more that we talk about Kimi and DeepSeek and the more that we worry about an AI bubble in the US, I think the more political backlash there will be against some of these Chinese LLMs. But just to round up this discussion, I thought it was interesting as I looked into Kimi's architecture. One of the reasons that it is more efficient than the American LLMs is that it uses this thing known as the mixture of experts design, whereas ChatGPT and some of these other LLMs are using a dense model. This mixture of experts design only utilizes certain parameters when queried, and a dense model uses them all. And apparently, the Kimi K2 is over 1 trillion parameters. But it will only use about 32 billion at a time. And this points to, I think, the example in which Chinese AI is at a research level evolving in a very, very different way. And so the more that I think about this space, and I'm trying to read up very quickly because it's changing so quickly, I see that sort of co-evolution of two very, very different species of AI that I think is happening right now between China and the US. Okay, we'll be back with more after a quick break, so stay with us. Welcome back. Tensions are well and truly boiling in East Asia. China and Japan are locked in a fiery diplomatic clash over Taiwan, with threats, insults, and even references to beheading now making the headlines. And it all started when Japan's new Prime Minister, Sanai Takaichi, said a Chinese attack on Taiwan could trigger a Japanese military response. This is a rare explicit stance from a sitting leader, and Beijing responded swiftly, summoning ambassadors, issuing warnings of a crushing defeat if Japan intervenes, and lashing out in state media, calling Takaichi a quote-unquote evil witch and warning Chinese citizens to avoid travel to Japan. The spat highlights more than just the issue of Taiwan. It also involves historical grievances, territorial disputes, and Japan's shifting security posture. Japan, America's key ally in the region, may increasingly act as a deterrent while the US pulls back. And Takaichi's hardline could boost her actual standing at home and abroad, even with conservative American allies. James, I think that this is giving me 2010 deja vu all over again when we had the Senkaku Island incident. We had the rare earths embargo for a couple months on Japan. We had a lot of everyday Chinese citizens boycotting Japanese goods, eluding Japanese stores.
And I'm not surprised, frankly, that China has reacted in a pretty aggressive manner. And I wouldn't be surprised if everyday Chinese boycott Japan entirely, as they've done in the past, anytime there has been an anti-Japan or hyper-nationalist movement. It's no surprise that Chinese airlines announced over the weekend that they would allow all passengers to cancel or change Japan-bound flights free of charge after Beijing basically urged the citizens to avoid visiting Japan. This comes at a time, I think, where Trump is clearly trying to pull back from U.S. commitments in the region. Japan, I think, is sitting there pretty worried about the state of affairs, given that it relies so heavily on the deterrence that the U.S. offers, and that Japan is not a nuclear power, which we'll get into in just a bit. I certainly would be nervous sitting in this region at a time where politically both sides want to play hardball. But what's your take on this, James?
Yeah, I mean, I've lived in Japan and China and Taiwan and you know the countries that are in play. It's amazing to me how quickly this has escalated. It's gone from 0 to 60 or 0 to 120 in what feels like a very short period of time. You know, I woke up on Sunday morning to see on my social media feeds 3 Chinese warships steaming towards the Senkaku Islands, which are a territory disputed by Japan and China. It really was quite dramatic. And I think it's important for the West as well, particularly for the United States, because, of course, Japan is America's leading ally in Asia. Japan also plays host to several U.S. military bases, and these are really major. The Yokosuka Naval Base in just near Tokyo Bay is the home port for the U.S. 7th Fleet. And there's a large number of U.S. ships there. And it also has the nuclear-powered aircraft carrier called the USS George Washington. This is one of the, the premier ships in the U.S. Navy. So any kind of a flare-up between Japan and China, especially if it has a military dimension, which this one very clearly does, is a big issue for Washington. And I imagine it's quickening pulses all over the US, just as it is for you and I. The Japanese side is now trying to de-escalate. They have sent over Masaki Kanai, who is head of the Foreign Ministry's Asian and Oceanian Affairs Bureau. They sent him to Beijing to see if he can sort of try and patch things up. But in the meantime, as you've already alluded to, this is hammering some Japanese stocks. You know, we've seen the Isetan and Mitsukoshi department store owner, that stock price has fallen over 10%. And also the Tokyo Disneyland operator, that's lost nearly 6%. Japan Airlines is down. This is all because these companies benefit hugely from Chinese tourists going to Japan. And as you've said, Alice, once nationalist fervor grips the Chinese people, as it is clearly starting to do, then you immediately see a drop off in the willingness of Chinese to buy Japanese stuff and to travel to Japan. I don't know. I mean, how do you see this? I mean, there is obviously historical context here. I mean, why is it that Chinese feel so triggered, as it were, by Japan at these moments?
Well, I mean, China had a harrowing experience in World War II at the hands of Japan. Japan occupied parts of China, even getting up to Shanghai, where my family's originally from. And the rape of Nanjing, or even the systemic wiping out of populations in China, are deeply, deeply remembered within the Chinese collective. And I think that probably intensifies a lot of already, I think, strategic rivalries and issues at play. So there's a deep set historical mistrust. But at the same time, I think when we look at it from a realpolitik standpoint, Japan is deeply worried about an ascendant China and what that means for the Asia-Pacific region. If the U.S. decides that it ultimately doesn't want to be a regional and global hegemon, Japan is in a very, very, I think, isolated state because it has no nuclear deterrence of its own. It cannot, according to the treaty that it signed after World War II, with the Americans. It cannot have an offensive military capable of warfare. And it has the three non-nuclear principles, meaning that it cannot possess, produce, or allow the introduction of nuclear weapons onto its territory. So I think Japan, from a realpolitik realist standpoint, is in a very desperate situation. And I'm not surprised that Takaichi is trying to draw into question the three non-nuclear principles. That is another reason why China is worried, because, and this is according to people close to her, she apparently wants to call to question the strict adherence of the no introduction of nuclear weapons principle, because ultimately she wants to allow U.S. nuclear-armed vessels to sit in Japanese ports to basically have a credible nuclear deterrence against China in a potential showdown over Taiwan or in the region. So this is, I think, all again driven by the tectonic shifts of power, mainly in terms of the U.S.-China relationship in the region. And I think ultimately I wouldn't be surprised, even if we do see a de-escalation in the short term, that there is like an increasing mistrust between Japan and China, and that Japan gets closer with, say, Korea, India, Australia, some of these other countries that could be on the opposing side of China if there is a showdown in the region. But just very quickly, James, having lived in Japan, do you think that there has been a shift in Japan's attitude towards China in the last few years?
Well, I mean, I think that certainly Prime Minister Takaichi comes from the wing of the Liberal Democratic Party, the LDP, which is known to be more hawkish towards China. She's seen as a little bit of a successor to Shinzo Abe, the previous prime minister, who was, considered to be fairly hawkish towards China. And I think that is already playing out in the minds of the Chinese and making China extra anxious about what the next few years of Takaichi's tenure is going to produce. So I think that this issue, this flare-up that we've seen at the moment, could set the tone for however long Takaichi is prime minister, even if there are attempts by the Japanese, as I'm sure there will be, to de-escalate. I like you, I see this as a well, maybe not a continuous source of tension, but, a general undertow of tension between the two countries.
Well, James, we're going to take a quick coffee break, so stay with us. Welcome back. This is my favorite section of this podcast, not just because I am a caffeine addict, but also I find this story quite astonishing. China's coffee wars are growing up, and Starbucks is taking cover, it seems. After nearly 30 years and 8,000 stores, America's Starbucks is selling a majority stake in its Chinese business to Boyu Capital, keeping just 40%. Local rivals like Luckin and Coty are surging ahead, opening thousands of outlets, cutting prices, and serving drinks, very bizarre drinks, I would say, tailored to local tastes, from pork drizzled lattes to alcohol-infused specials. Starbucks' premium strategy and slow product rollout just couldn't keep up in the end. This joint venture gives Starbucks local insight, faster expansion, and digital integration, critical in a market that remains dominated by WeChat Pay and Alipay. Now, other US brands like Burger King and Decathlon are following suit, selling their stakes to local partners to survive amid China's hyper-competitive consumer landscape. Now, the big question is China still a land of opportunity, or have homegrown brands completely rewritten the rules? James, I love this story for many, many reasons, as already alluded to. But also I had noticed from a friend who sent me a message earlier in the year, I believe over the summer, that they had picked up a pineapple cold brew from Luckin's New York store. And I realized then that Luckin, a coffee brand that I'd long associated just with China, has become very global in the last few years. And what surprises me, James, about this Luckin story is the fact that now they're looking to list in New York. They've got, at least to my knowledge, 2 New York stores. And this is a company that a few years ago during COVID went bankrupt. And prior to that, had cases of financial fraud, which prohibited it from listing in NASDAQ. So it has really turned things around by becoming now a profitable company that ultimately has its eyes on listing in the New York Stock Exchange again. So I was surprised to see that they not only have become profitable again, but they are trying to relist in the NASDAQ and now have at least 2 stores that I know of in New York, where apparently the regular priced iced latte costs as little as $5.75. Now, I've compared that to some of my colleagues living in New York who say that at Starbucks and other places you could get an iced latte for $6 to $8 US dollars, but listeners should definitely correct us. I do know for a fact that people who download the app as first-time users can have a coffee for as little as $1.99. So this is a strategy that they've definitely kept alive, that has been successful in the Chinese context. But I am a little bit skeptical that they can do a reverse Starbucks and be as successful in America, because I do think the Chinese market is quite different, and that they'd have to burn a lot of cash to really survive in America. But it's interesting to see these hungry executives in Luckin, but also another tea company that I really love in China called Chaji. They do specialty iced teas. These executives are really trying to jump over the Pacific and be as successful in America as they were in China. I'm a little skeptical, but James, please refute me if you disagree.
I love that. I mean, I hadn't heard that story. Luckin Coffee going to America and selling coffee for $1.99 a cup. Yeah, I mean that's really quite something. I certainly wouldn't have any qualms about buying a coffee for $1.99 if it tasted okay. But this story has quite a lot of resonances for me too, because I was in Beijing when Starbucks arrived in 1999. I reported on the first Starbucks shop, which was in the World Trade Center. And, at that time, we all, I certainly wasn't the only one, or the journalists there were all writing about how Starbucks had the chutzpah to try to sell coffee to a country with thousands of years of tea culture. There was a lot of quotes from people saying this will never catch on. And then look how wrong we were. There's literally thousands and thousands of stores. So that was one thing. But the other really fascinating aspect of this story to me, which I hope you'll be able to help me with, because I think you're much more of an expert than I am, is what it says about Chinese tastes. You already mentioned that the halo effect of foreign brands, not just Starbucks, but plenty of others in China, is beginning to slip. We've seen Apple giving ground to local competitors. We've seen Estee Lauder giving ground to local competitors. LVMH in the luxury sector doing the same thing. So the other aspect of it is the localization, which maybe includes a better understanding by Chinese companies of what Chinese really want to drink or to eat. And I don't know, maybe this is a bit outlandish, Alice, please tell me, but I found something online about a coffee shop that opened in southwestern China that had cooked pork intestines like on a skewer on top of the coffee. And then there was also, actually, this was Starbucks earlier on, I think it was the end of last year, putting like pork fat drizzle onto their coffee. I don't know if this is the sort of the outlandish edge of this, but maybe there's something more mainstream to say about Chinese taste and the ability of Chinese companies to understand Chinese taste better than foreign companies. Do you think there's anything in that?
Well, firstly, I think that those are probably a bit more outlandish. But certainly when I do, again, I'm going to tell the story because I distinctly remember now that you're talking last year during the summer, what was viral at the time was people putting multi in coffee. So multi, for listeners who don't know, is China's sake, although, many people who don't like multi would say it probably tastes like a poor man's sake. It's a type of white spirit. And so they were trying to revive the multi brand and mix it with coffee. And apparently it was really viral online, and especially Gen Z, young Chinese people were going out and drinking these multi iced coffees. But the reason I tell the story is that the Chinese marketplace is so quick moving and evolving, and they love fads. They love new trends. And so in a way, this sort of hyper experimentation fits within the Chinese model. But the other thing that I think that the Chinese model shows that I think will be more well received rather than these crazy pork fat lattes in the US context is the technology platform. So in China, when you go to a Luckin or a Chaji or any of these chains, almost nobody orders at the till. In fact, if you do, people kind of stare at you strangely, and you don't pay with cash. Almost everyone is paying in-app or with a QR code. So they pick up. It's a hyper efficient business. And when you see the people move, it's actually quite a sight to behold. And I think bringing some of that technology and operation system to the US context could be quite well received and just make the whole operation more efficient. I'm not so sure about these crazy tastes. And already when I see the Luckin Coffee menu in New York, it's a bit more tame in terms of what's available. Right now, they're going on the Thanksgiving theme with these, caramel popcorn ice lattes, these cinnamon pumpkin ice lattes. So more within the US Thanksgiving theme. But certainly the way you were telling that story, James, about how coffee really did take China by storm because it changed the culture, I think is an important lesson, because I don't think anybody looking at Starbucks in the early 90s could have foreseen, the fact that coffee really took over China. The flip side of this is that Starbucks has already reached peak China. Its market share in China fell from 34% in 2019 to just 14% as of last year. And this is, again, another sign, to your point, James, that as tastes have been westernized within China, they've gone back to finding Chinese alternatives. And on future episodes, I'd love to explore that with different brands in luxury, in retail, in food. There's a story about gold here to tell as well, with Lawpool being Chinese Cartier. I think that this is the ongoing trend, is that there's going to be these Chinese alternatives that cater to changed palate over the last few decades. But yeah, certainly I'm excited to head over to New York in a week or two and try some of these New York-made Luckin coffees. All right, James, this is my favorite time of the episode, prediction time. What's your prediction as you look at your crystal ball?
Okay, I've got something about humanoid robots. This is one of my favorite topics. I mean, we have mentioned humanoid robots before, but I've got a specific prediction. So Wang Xingxing, who is the head of Unitree, that's the company that makes one of China's most advanced humanoid robots, said that humanoid robots in China will reach their, what he called ChatGPT moment, within 3 years. Now, he defined the ChatGPT moment for robots as when a robot will be able to walk into a room that it's never been in before, find something like a glass of water that it's been asked to find, pour the water into a glass, and then bring it back to its host and give it to them. So at the moment, this is not how humanoid robots work. Humanoid robots are pre-programmed to do specific tasks. What he's talking about is where a humanoid robot can assess its surroundings, think what it needs to do, find a solution, and then deliver on the solution. He says that should happen within 3 years. I reckon it's going to happen sooner than that. I reckon that by the end of 2027, we will see the ChatGPT moment for humanoid robots, and it will happen first in China.
Firstly, it's to my Luddite ears, a horrifying eventuality. I'm very scared of robots, I have to confess. But as you were talking, I was thinking, gosh, the Chinese have definitely prioritized a different part of the AI stack, whereas the Americans have gone in and poured a ton of money into LLMs. I don't think it's a surprise then that you have Meta's AI head, Yan LeCun, basically leaving and going into world models. So trying to be more in the space of embodied AI, humanoid robots, of real world AI data. So again, definitely watch this space, but I would agree with you as that China is leading when it comes to this humanoid AI robotic space. So mine is also AI focused, and I'm going to piggyback off of what we first talked about. It honestly surprises me that the Trump administration hasn't gone out yet and banned Chinese AI models. I feel like that's a pretty low-hanging fruit. There was speculation earlier in the year that they could ban DeepSeek. I think this is one of the policy areas in which you have an alignment between the Silicon Valley tech companies that are competing potentially with Chinese LLMs. So call it Meta, Google, etc., OpenAI, and the national security hawks in Washington, who, to your point, James, are very worried about the security implications of companies and even officials using Chinese LLMs. So I think in 2026, we may see more politicization around this issue that might ultimately push the Trump administration to issue some kind of entities listing for these Chinese AI models, effectively banning them from being used.
Reporting third quarter earnings yesterday, revenue slightly beat expectations, but the company missed on earnings per share. The retailer also cut its full year guidance. Earnings for 2025 are now expected to fall 5% instead of previous projections of 2%. The stock closed down 6% yesterday. So why do we care? Well, Home Depot can tell us kind of a lot about how the American consumer is doing. Its results are also closely tied to the housing market. And on top of that, the company is relatively exposed to the tariffs. So to help us break down what these earnings tell us, we are speaking with Joe Feldman, Senior Managing Director at Telsey Group. Joe, thank you very much for joining us on Prof Markets.
Yeah, thanks for having me. Excited to chat with you.
So we want to get your reactions to these earnings. Beat on revenue, missed on EPS, stock fell 6%. Take us through what happened with these Home Depot earnings.
So I think what happened was expectations were a lot higher heading into the print, really self-induced by Home Depot. If you go back a quarter, they saw some momentum in the business. They had a better spring, early spring, summer period. And they thought the second half of the year was going to be even better. They thought there would be continued momentum. So we in the street all expected higher sales trends coming into this quarter. And then when the quarter materialized, it didn't happen. Basically, the consumer stayed kind of stable. So their underlying business stayed stable at around a 1% growth in terms of comp. But there was some pressure because of the lack of storm activity. Usually, hurricanes are a good thing for Home Depot, for Lowe's. And when that didn't happen, it caused further pressure on sales. Then the margins start to deteriorate a little bit. And you saw some deleverage, and so the earnings came in a little bit worse. And the investor community was a little frustrated with what happened.
Can you tell us more about how hurricanes relate to profits at Home Depot? It's a strange thing in the business, but it is important.
Yeah, no, it's very important, actually, that in the third quarter and sometimes in the fourth quarter, where big storms can have a big impact. Because when a hurricane comes and there is some destruction related to it, or tornadoes and other storms, houses need repair. Roofs might get damaged, gutters might get damaged. And so when that happens, the consumer usually comes back in force in that region soon after the event to try to repair their homes. This time around, in the third quarter of 2025, we didn't really have any major storms like that compared to 2 last year, late in the quarter around October. And those storms had a big positive boost to Home Depot, Lowe's, Tractor Supply late in the quarter a year ago and their fourth quarter. So now when you look ahead and you don't have any storm activity or recovery activity to happen, that's going to put some extra pressure on the sales. So
interesting. Aside from the hurricanes or the lack thereof, which was interestingly a bad thing for the company, was there anything else? Was there anything that we learned about the consumer, perhaps? I mean, I feel like Home Depot's generally considered to be like a bellwether for how the consumer is doing. Did that play a role in these earnings here?
I think the consumer was definitely front and center, and it's always a much talked about topic, as you said, with Home Depot as a bellwether. And their consumer is actually pretty healthy. It was interesting. Now, you may not think that when you look at the sales trend. However, big ticket sales were actually up a couple of percent. That would imply that people, when they do go to shop, they're opting for, new innovations, newer products, things that may have advanced technologies within them. I'm thinking of appliances and power tools and things like that, where they are stepping up. So that would imply that the consumer has the money to spend. The homeowner, by definition, tends to be a bit more affluent, just because to own a home, you need to be. And so I think they're seeing resilience among their consumer. It's just they're not seeing people, digging in deeper to go after bigger projects like a bathroom remodel or a kitchen remodel. And that's really what's causing the pressure. The day-to-day repair and maintenance is happening. And that's why I said earlier that the business is relatively stable, because that underlying core business is fine. And we're seeing consumers spend and shop. It's just that incremental spend is not happening because that otherwise considered discretionary within the home improvement space is not happening because people are just a little bit more cautious. Maybe they're waiting for interest rates to come down a little more to finance some of these projects. And, home values are still up. But with lack of housing turnover, there's also some pressure there. Usually people will do some extra work to clean up the house before they sell it or soon after they buy it. And with the lack of turnover, that hurts as well. So broadly speaking, the consumer is somewhat resilient. They're spending. It's just that they're not spending beyond what they need to spend on the day-to-day maintenance.
Have tariffs played a role in the story here? I mean, Home Depot, I believe it imports quite a lot of its inventory. Have tariffs had any effect on the business?
So far tariffs have not had a significant effect at Home Depot, nor at Lowe's. I mean, we'll hear from Lowe's tomorrow. But I think what we've seen is that the tariffs, over half of what Home Depot buys is domestic. So, a little less than 50% is imported. Those goods, there are tariffs on. They've been able to mitigate a lot of the tariffs through negotiations with suppliers, through, cost controls on their own end, maybe, operating it more efficiently. And there has been selective pass-through. They've not really seen much pushback on the pricing pass-through that they've had to do. It's not been too dramatic. You do see it in appliances, power tools, things like that come out of China or other parts of the world. But, broadly speaking, tariffs were not a major impact in this quarter.
But they are increasing prices, and they are saying that it's because of the tariffs. In other words, it's impacting the consumer at least a little bit.
Yes, I think broadly, yes. To expand beyond the Home Depot story, you're absolutely right. The
Yeah.
consumer is very much feeling the impact of tariff-related price increases. There's no question about that. And I think the Trump administration response on food the other day really reflects that. I assume when we hear from Target and Walmart later this week, we're going to hear that tariff pressure is there. It's real. It's causing consumers to have less discretionary dollars. It's causing consumers to be a little sharper and tighter with how they spend. They're seeking out more value. So yes, broadly, the consumer is definitely being impacted by the higher prices that are starting to flow through. And it's really just starting, because if you consider when the tariffs really did jump up a little bit, inventory that's now hitting the stores for this holiday season and into next year, that's the tariff inventory at the higher tariffs that are in place today.
Just before we let you go here, what did we learn about the guidance? I mean, is there anything that the guidance for Home Depot could tell us about the economy at large? I mean, can we learn anything from these earnings about what will happen either on tariffs or on anything else going forward?
Yeah, I think the guidance from Home Depot reflects the fact that the macro, or more specifically the housing market, is still rather sluggish. And we're just not seeing that pickup that we would have expected to see at this point. Now, we are seeing a more stable housing market, and the turnover is running at around 4 million at an annual run rate. 4 million units are turning over. We need to see it higher. We want to see it higher. And I think Home Depot wants to see that. They also want to see lower interest rates that would help people to finance projects. So I think their guidance shows that caution that we're just not getting that incremental lift from the industry that we would like to see at this point. I do believe Home Depot is taking market share reflected in their current business. I mean, it was positive sales. They generated $41 billion of revenue in the quarter. But the go forward, I think there's going to be some caution in 2026 as well. Tariff-related pricing pressure on the first half of the year on the consumer is going to continue to weigh on things. And so you may not see this sharp rebound in the first or second quarter. We're hoping spring, so maybe second quarter, you'll start to see a little bit of a lift, but it still looks like we're going to see more of the same for the next couple.
$15 billion in its first US dollar bond offering in 3 years. It's not alone. Google sold $25 billion worth of debt in the US and Europe earlier this month. Meta issued $30 billion of corporate bonds in October. Meanwhile, Oracle is already carrying $104 billion in debt, and it is lining up another $38 billion. All of this spending adds up. These deals have contributed to a record $6 trillion in global debt issuance this year. In sum, big tech is now financing the AI boom with borrowed money. just as investors are starting to question how and when this AI build out will actually pay off. So, here to explain the role that debt is playing in this AI boom, we are speaking with Robert Schiffman, Senior Technology and Internet Credit Analyst at Bloomberg Intelligence. Robert, thank you very much for joining us on Prof G Markets.
How you doing, Ed?
Doing very well. Thank you for being here.
Awesome.
So, a lot of big tech debt headlines in the news recently. Amazon raising $15 billion. We saw Google raise $25 billion. Meta raised $30 billion. These seem like very big numbers, but for those of us who are, less familiar with the debt markets, how big are these numbers really? Why are we seeing them? And why do they all seem to be happening kind of at the same time, or at least in the same month?
Yeah, it's even bigger than what you said, because Oracle did $18 billion of public debt, and they're looking to do $38 billion of private debt. Meta did another $27 billion of off-balance sheet debt. So we're actually in a record year for debt issuance, public and private. And it's a little bit of a question of, if we build it, will they come when it comes to AI? I actually think it's the other way. I think the demand has come. So these companies are building it. And the reality is, this is just the early stages. There is a lot more spending to go. I think we're going to see hundreds of billions of dollars of debt over the next few years, because we're likely to see $3 trillion of AI cap spending cumulatively from probably a handful of the largest hyperscalers through 2030.
So those names you mentioned there, these are all companies that, generally speaking, already have quite a lot of cash on the balance sheet. You'd kind of think that if you're Google or you're Meta or you're Amazon, that you don't need to borrow money. Do they need to borrow? I mean, do they not have enough cash already to just finance this themselves?
Yeah, listen, the old adage in the bond markets are, you borrow money when you can, not when you have to. And right now, the market is still ripe for lending. If you can take down 10-year money with a 4 handle on it, so a 4% coupon, you're going to do that all day long. You can borrow 30, 40, 50-year money with a 5 handle on it. You're also going to do that. The reality is, they have enough money today that if they didn't want to borrow another dime, they could probably get away with it. But what it would do is, it really pulls resources away. It pulls financial flexibility away, because most of these companies, other than Amazon, are also spending 30, 50, 70, in the case of Apple, $100 billion a year on shareholder returns. So how do you do everything is really the question. And this enables borrowing money, enables them to both invest organically, continue to do M&A, and pay significant dividends and share buybacks. Over the next couple of years, some of the companies like a Meta are going to be spending more money than they're pulling in, if they continue on a shareholder return path they've been on. So they actually do need money. Others, like an Oracle, which are BBB rated, are just flat out free cash flow negative. They're spending a lot more than they're bringing in. So it's a little bit idiosyncratic. But remember, for years, most of these companies, whether it's Meta, Google, Amazon, Microsoft, they've been very conservative in terms of their balance sheets. AA balance sheets, AAA balance sheets, 50, 75, $100 billion of cash. They've been setting themselves up for an opportunity like this. So they position themselves very well. That being said, borrowing money today makes a pretty good argument that they're going to spend a lot more money tomorrow.
You mentioned there that, there's this question of, if we build it, will they come? You said that you think the demand already is there. I think the AI bears would say, well, yes, there's demand, but it's all kind of circular. It's all coming from the same people. I mean, OpenAI wants to buy compute, but NVIDIA, they're the ones who have been investing in OpenAI, and then OpenAI takes that money and spends it over at Oracle. In other words, the demand is artificial. To the people who are worried about that prospect, what would you say to those people?
Yeah, there's been a lot of incestuous type of investing here. That doesn't mean that true third-party demand doesn't exist. I actually think it does. I think every single business is looking towards these large hyperscalers to create an AI backdrop for them. They cannot do that on themselves. Every one of these companies constantly are talking on their earnings calls about they have much more demand than there is supply. And that's why they're spending so much. I understand the naysayers, because if you're spending hundreds of billions of dollars, if not trillions of dollars right now, and you're not seeing returns for the next 2, 4, 6 years, you get skeptical. In particular, the skepticism, though, is coming from the equity markets. We saw stocks skyrocket, all-time high valuations, expectations that every single one of these companies were going to the moon and beyond. The credit markets, though, have been, I think, a lot more based in reality. Um, Spreads have gotten a little bit wider as all this debt has come. That being said, there hasn't been the same sort of panic or sell-off. We're not 35 or 40% off from our highs. We're just a little bit wider. And I think that's really the market that you need to look at to see, is there really pessimism? Is there really some sort of systematic problem? And the reality is, I think the market is much more fighting headlines on return on investment that they are whether or not these are going to ultimately pay off. They are going to pay off. The question just is how much. From a credit side, pretty much everything's trading at par. Things are trading near historic tights. That says our market is pretty comfortable that those cash flows are going to be there in the future. Equities are just a different story. Perhaps they got ahead of themselves, and that's why they're coming back. And that's where we're seeing a little bit of the panic in the market. But we've been asked whether or not this is a systematic potential risk. And I don't see it at all. And the difference between now and, say, the dot-com era is the dot-com era had companies that weren't generating any revenues, raising money via IPOs at ridiculous valuations that could never be justified. Here, you actually have companies collecting money. The reason why Amazon stock took off after the end of the quarter was because AWS, its AI and cloud business, had its best quarter in 3 years, off of really large numbers. And you're seeing that across this space. So we've got really big companies generating real revenues and real cash flows today, and they're spending money to make money in the future. I just don't think that the type of worries that people have out there really are justified.
Yeah, it sounds like you think that, yes, they're taking on a lot of debt, but for the most part, it's justified and responsible. Are there certain companies that aren't doing it right, though? I mean, I think of Oracle as an example. You mentioned they've taken on more than 100 billion. Investors seem to be getting a lot more anxious. You mentioned their credit rating. I think you said double B, or somewhere closer to junk. Are you concerned about a company like that, or maybe a company like CoreWeave, again, which is borrowing quite a lot? Are there companies doing it right and companies doing it wrong?
Yeah, it's not necessarily right or wrong. It's just the starting point. So some of the largest companies like Microsoft or Amazon or Alphabet have AA or AAA ratings. So their balance sheets are already prepped for more borrowing. They have little or no leverage. Absolute debt might be high. They might have 50 or $100 billion of debt, but they also have 100 or 150 or $200 billion of EBITDA. So in the world of credit, it's all relative. Leverage is still very low. As you move down the credit scale, somebody like Oracle, who's BBB rated, this is sort of important, that they are investment grade. They're mid BBB. They've got negative outlooks at S&P and Moody's. People are worried that a name like that could fall to junk because the free cash flow is going to be so negative over the next couple of years. It doesn't mean they're doing anything wrong. And in fact, it appears as if they've got about $300 billion of contracts coming from what we believe is OpenAI. If they're spending money now, they're more than willing to go into a cash flow deficit in order to meet that demand over the next few years. So it's not a matter of right or wrong. It's just their balance sheet is starting in a different place. And what that means is that credit risk is going to be higher because they're BBB with 100 billion plus of debt and adding more debt versus a Microsoft that's AAA that has less debt that's adding debt. So it's still a little bit relative. I don't think it's right or wrong. I think it's all sort of right. They're actually all going after very similar dollars. This is a huge pie of potential revenues, but there's only a handful of players here that are actually building super deep moats around them. They're going to make it so that there's going to be such large barriers to entry that no one else is going to be able to provide these services. So if that demand does end up playing out, I think we're going to be looking back at now and saying, why didn't they spend more money? And I think that's
Yes.
a fair argument. Is we just wrote a note on Amazon saying that they're going to spend $1 trillion over the next 5 years. Is that too much or too little? I actually think it's going to end up proving to be too little.
Yeah, I think those are all fair arguments. I think my position at least is that the very important word there is if. If it is the case that the demand is coming, if it is the case that OpenAI will spend those $300 billion, there are a lot of ifs, which I think make people like me and I think other investors kind of nervous. But just at sort of a general level, how much debt is too much debt? Like, at what point do we look at what's happening and say, yeah, we're going too far? Like, what is that line, do you think?
I don't think we're anywhere near it. And the reason why is credit markets, again, it's about relative numbers. If you have growing cash flow, if your EBITDA is going from 100 billion to 200 billion, growing your debt levels from 50 billion to 150 billion might not mean that much. Your leverage still might be very, very low. So your absolute debt levels might be really high. I think this market is ripe for dramatic more borrowing. If you look at some of these transactions, the amount that the books were oversubscribed, the book talk on Amazon, they raised 15 billion of debt. The buzz on the book was it was $80 billion of demand for that $15 billion of debt. What if Amazon wanted to raise $100 billion? How much would the book of demand had been? You know, it's sort of hard to say, but these deals are being way oversubscribed. There's a lot more money chasing this debt, particularly for the high quality names, than not. Yields are hard to come by. In a spread compressed environment, generating alpha and excess returns is very difficult. These are all very highly rated, high quality companies. People are not used to this levels of debt. I'm telling people, get used to it, because we're going to see more, because they want to build more. And if you say to me, how much more can they borrow? I don't know what that number is. I just know it's more, and it's more by a lot. And by the way,
More.
let's say I'm wrong. Right? I sort of sound bullish, right? Say I'm dead wrong, and that you're only going to get half the revenues that these companies are expecting. The reality is the vast majority of them, certainly these AA's and AAA's, it's going to primarily be an equity impact. The credit profiles, if you go from AAA to AA, you're going to get your money back. If you go from AA to single A, ultimately you're going to get your money back.
Yep.
But if your equity is valued at 30 times earnings and your revenues are growing at a much slower rate, 50% less than what the market anticipates, your multiple could be cut in half. Your stock price could be cut in half, and you can get crushed. And I think that's a little bit of what's going on now. Just like you said, everyone's asking what if this doesn't happen? What if those revenues don't come? What if they're not there? It's really much more of an equity risk, even though this is being funded on the back of bondholders. The equity holders are actually taking much more risk than the debt holders, from my perspective. And that's why you're going to see even more debt.
Yes, which is itself concerning for some people as well.
Well, listen, these are the Mount Rushmore of credits. If you think about names that are positioned to borrow more money, these are the names. They've run historically very conservative financial policies. They've got tons of cash. They generate a lot of cash. They can add a lot of debt. The rating agencies are providing support and letting them grow into the balance sheet. So what I would say for the everyday person who's not even investing, this is a great thing. This means the benefits of AI are going to come to you sooner than later. And I think that's what all these enterprises are looking for. They're desperate to enhance efficiency. Sometimes it means firing people. Other times it just means the ability to sell more products and services. And they need these hyperscalers, and they need these products and services quicker. So the faster they can be built, the better. And I think that's actually good for everybody.
All right, you are bullish. I'll tell you that much. We appreciate it. Robert Schiffman, Senior Technology and Internet Credit Analyst at Bloomberg Intelligence. Robert, this was great. Thanks for joining us.
Thanks so much, Ed.
Well, as Robert told us, record year for debt, both public and private, more than $6 trillion issued this year. And as Robert also told us, it is only going to continue. In his words, expect, quote, more. Now, clearly, Robert isn't so worried about that. Part of that is probably because he's more focused on the credit markets than the equity markets. As he said, the equity investors are actually quite exposed here. And part of it is also that he is fundamentally bullish on AI. And that is a fair position, and many people take that position. But regardless of what you think of all of this, the point does stand, and that is that we are borrowing more money than ever before to build AI. And that is your story and your career. But I first want to start with just a factual statement about America right now. And that is that trust in media, whatever media is at a record low. So when you poll Americans, only a third say they have any meaningful trust that outlets report the news fully and fairly. And then more than a third say they just do not trust the media at all. You have started one of these new media companies in Substack. What do you make of that statistic? And how does it affect the way you think about your company?
I definitely think we're in a time of profound change in media. And my model of this is it's sort of a technologically driven change. You know, the internet came along and smashed a lot of the existing business models for media and culture and created these massive new networks that are fantastically profitable businesses without necessarily replacing kind of the economic engine that sustained a lot of this stuff. And anytime you have in history, if you have a major sort of revolution in media or information technology, whether it's the internet or the television or the printing press, you often get kind of a period of unrest or a period of destabilization or a time of cultural churn as we sort of adapt to the new reality. And I think we're in one of those times now. I think we're still reeling and sorting out what happens when you wire the whole world together into one internet, and layering onto it now what happens when anybody can make all kinds of media with AI, it's sort of like we're in the period of destabilization caused by technological change.
Did you know that that was going to happen when you started Substack? And this is, really a question of the origin story of Substack. Was this something you predicted, and what was the inspiration behind Substack?
This is why I wanted to start Substack. And in fact, I wasn't setting out to start a company when we started. I was setting out to write an essay. I was actually on sabbatical, taking some time off after my last company. And I was writing this essay trying to outline my frustrations with the media economy on the internet along these lines. And I felt at the time that it was already happening. Like I felt, I could look at, I would talk to people in 2017 and say, I think Facebook and Twitter are driving us crazy. And people would kind of go, ha 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 ha. Yeah, maybe that's right. But it didn't feel very serious. And, I'd say, I think people are going to be willing to connect directly and subscribe to the voices they trust. And people would say, yeah, maybe, I don't know, that's interesting. Probably people will never pay for somebody. And I think just a lot of that has proven, to my mind, true. The thing that was sort of like an interesting curiosity when we started the company, people are starting to feel a lot more viscerally now. And this is why you get these surveys. People are saying, like, I don't know if I can express exactly what's wrong, but something is wrong. And I'm hungry for something better. And I think you can it's easy to be a doomer about that situation. It's easy to look at it and say, there are lots of problems and nobody trusts these things, and look at these negative effects. I think it's also a time of incredible opportunity. I think we're in a moment where we're going to be building the new world, and there's not going to be, we don't get a choice of whether or not we get change, but we do get a choice in what kind of change we get. And that's the thing that motivated me to work on Substack in the first place.
Before Substack, you started this company called Kick. You're the co-founder, you're the CTO. You later decided to leave that company, and then you, as you say, you ran into starting Substack. Can you just tell us like the brief story of starting that first company, and then actually how you got Substack off of the ground following your first company?
I was the technical co-founder, but my co-founder, Ted Livingston, who was the CEO, it was really his baby. And I sort of stumbled into that company. I met Ted when we were both in university, and we started working on it. Anyway, I won't get too deep into that, but we wound up making this messaging app that got really, really big. Actually got really big twice. It got really big, and then BlackBerry, who was a big player at the time, tried to kill us and almost succeeded. And we built it back up from nothing, got hundreds of millions of users, raised money from Tencent at $1 billion valuation. It was a crazy, wild experience. I learned a lot about building things that matter. I learned a lot about how much impact you can have making technology if you do it well. And I also got this abiding belief that there's a lot of power and responsibility in building these kind of virtual places where people increasingly lead their lives online. You can't change human nature. It does exist. People are a certain way, and you shouldn't really try, is maybe what I think. But even so, you can take the exact same set of people with the same strengths, the same flaws, the same beliefs, and depending on how you set up the rules of the game, depending on how you set up the space they inhabit, how it gets communicated, how it all works, you can kind of create a heaven or a hell with the exact same people. And so the act of sort of creating these online worlds, I think, is kind of tremendously powerful. And if you do it sort of with the conscious aim of making one that's good for the people that live in it, you can make something really great. And that was sloshing around in my head. As I say, after I left, I was taking some time off. I was just doing all the things that you don't normally do when you're running a high growth company, like see friends and family and read books and learn to fly airplanes and indulge hobbies. And I've always been an avid reader. My dad's an English teacher. I grew up in a house full of books, and I've always believed that what you read matters and the media that you consume in general matters. It's not just, people watching this podcast. It's not just how they spend a good fraction of their life. And even if that's all it was, that would be good enough. But the stories and ideas you put into your head change you. They shape how you see the world. They change your experience of your own life. What you read and what you watch changes who you become. And so great writing and great culture is this deeply valuable thing. And so in my little sabbatical time, I was thinking, I should write. I know how to read. I know how to type. I have that good sort of tech bro hubris. I was like, how hard could it be? I should write an essay. And so I started writing that essay that was supposed to be originally going to be a blog post or whatever. I shared it with my friend Hamish, who's actually a real writer. And that was sort of the origin.
There were blogging sites before. People have written stuff and posted it on the internet for a long time. What was the core idea of Substack? Because you could go on Blogspot and find people writing stuff. You could find people writing stuff online and on the New York Times. I know it's a slightly different setup, but what did you see as different about what Substack was?
The core idea is we're building a new economic engine for culture. The problem as we see it is that it's not, there, as you say, there was already, the internet came along, and it did one revolutionary thing, which is let anybody publish.
Yes.
And kind of like unshackle the media environment from the gatekeepers. I say that there are still gatekeepers, but you can't keep the people in anymore. You can't lock people in. You can lock people out, but you can't lock people in. But the problem was that there wasn't, if you were a creative person, if you were a writer, if you're a journalist, there wasn't necessarily a great way to make money doing the work you believe in. And if you believe that great media, great culture is valuable, you want there to be a way to make money and to have kind of like a social contract that lets you do the work you really believe in. And, in the early days, sometimes people would accuse us. They'd say to me in an accusatory tone, they'd say, Substack is just blogging with a business model. And I'm like, that sounds pretty good, right? Blogging was this really cool, there was a golden age of blogs that was sort of this intellectual infusion. But the problem with it was there wasn't really a business model to back it up. It was things got acquired or things kind of stuffed ads in a way that didn't really work. And so you were missing, if you were an ambitious young person who had something to give the world, and wanted to make this a career or make this a business, it was hard to see a way to do it. And there was sort of the legacy media, which was in decline, and there was kind of this, this new world of social media, which you could potentially get a big audience, but wasn't going to give you a way to make money doing the work you believed in.
Just to describe the business model of Substack to the audience, my understanding is Substack takes 10% of the revenue that the creators charge when they put up a paywall. And in that sense, the real innovation of Substack to me, to your friend's point, was the business model. It was to say blogging can be paid for upfront. It can be put behind a paywall, and an economy can be created out of that business model. There will be enough content, enough creators out there with good enough content that people will actually pay for, such that this makes sense as a business. I feel like that was the innovation that no one seemed to think would work. And yet here we are, and it's working incredibly well. And within just a few years, there were 500,000 paid subscribers, and obviously that number has grown dramatically since.
Yeah, it's well over 5 million now.
Well over 5 million. Would you say that is that was the real innovation? It was you saying, actually, you can put this behind a paywall?
The paywall is maybe not the core of it, but it is the economic bargain. And look, I think great companies in my mind come from the fusion of a really grand, ambitious idea for the world paired with like a modest but achievable first instantiation of that idea. And the big idea for this is like, look, you can have a different social contract for media and culture. The idea that this stuff is valuable and the idea that, you should be willing to pay real money for something that is as meaningful for your life as, a great essay or a great podcast or a great book or a great community or, any of these things. That's actually a very big idea. And once that engine starts to go, this is what you're seeing in the Substack app now. The Substack app is the best place on the internet. It's still very small compared to, the other sort of at scale social networks, but it's, some of the best and smartest and most interesting, most creative things are happening there because of this different economic model. It's kind of like there's like a social contract and a philosophy behind it. But at the time, when we started, nobody thought that anybody would ever pay for anything. I had this parlor trick because I would describe this idea for Substack to people, and they would say, that sounds nice. It would be cool if writers got paid, but no one's ever going to really pay for something on the internet. That's not how it works. Like people would tell me I would never pay for some person on the internet. And my parlor trick was I would say, well, who's your favorite writer? And they'd say, so-and-so. I'd be like, would you pay $5 a month for them? And they would say, well, yeah, for them, for that person, I would. But that's different because they're really good. I've grown to trust them. They've got this, they've got something, there's something about that person that they love. They wouldn't do it in the abstract, but they would do it in the specific. And that kind of told me, okay, we're actually at the moment where this is ready to happen. Like it's lots of people doubt that it can happen, but it can work. And, we had sort of like the very initial version of this was, paid email newsletters made simple, right? That's kind of like the MVP kernel that fully, is the first full realization of the big idea that unlocks for writers.
Yeah.
And for a long time, I think people who wanted to copy Substack, including, Twitter and Facebook and lots of other people, they mistook the thing that was working about Substack as the surface level thing. It's like, it's, email newsletters are the secret, or, this thing is the secret. But it is actually the underlying economic model and the philosophy that makes it go.
When was the moment that you realized you had something great? And I will just conjecture, Substack was on my radar during COVID. I would hazard a guess that was the moment. But when was it for you?
There's a few moments that stand out in my memory, but I'll give you two. And the first was actually when we launched the very first customer. There's a piece of received wisdom that, among professional gamblers, they tend to have started out with a big winning streak at the start of their career. And And of course, if you think about it for a second, that's not because, the reason for that is because people who start their career as a professional gambler with a losing streak actually don't go on to become professional gamblers. It's just a selection effect. It's like, oh yes, that's the origin story of these things. And I feel a little bit like that because our first customer was this guy, Bill Bishop, who had been writing an email newsletter about, China for an international business and government audience for ages. He was perfect. There was probably like 5 people in the world that were the perfect first customer for Substack, and he was one of them. And he had been thinking about charging for his work. He'd been inspired by Ben Thompson, but he kind of couldn't be, didn't want to futz around with all the technology. So he was sort of this perfect first customer. And we like hacked together the first version. I built this little website and plugged it into Stripe. And I remember launching on his first day, and like 6 figures rolled in like within hours. And I was kind of sitting there on my computer being like, I can't, like, this seems really good. I can't, like, I don't know what I expected, but this is way more than that. And we sort of, we had this really big first success at the gate. We got into YC. We sort of had this, the very first thing we tried was this massive success. And that gave us a lot of confidence that we were onto something, even though there was sort of like, that was the biggest thing for a while. Like there weren't 20 more Bill Bishops we could go get at that time. But we had this, it gave us kind of like the confidence we were onto something. And then maybe the second one, I think, COVID 2020, there was a combination of suddenly everybody has a bunch more time and a bunch more money. And so there was sort of this great reshift in the economy where all of the online things or all of the virtual things got this huge stimulus and all of the real world things got this huge setback. And Substack was a really good online thing. It was, something really valuable and meaningful that you could do on the internet. And there was it was sort of a fever pitch moment for some of those tensions with media. There was a time where a lot of the best and most interesting independent thinkers were getting summarily turfed, to be honest, from their perches at traditional media places. Barry Weiss was pushed to resign from the New York Times in that time. There was a whole bunch of people that were fantastic on Substack.
The way that everyone moved away from these traditional outlets was pretty incredible. I think Barry Weiss is a good example of that.
So like moved away. A lot of them were pushed out.
Literally pushed out. You said something there as well that the amount of money that people had in their pockets, likely because of stimulus, and then also people are not spending on concerts and they're not spending on going out to bars anymore. Like people were relatively richer during COVID than they are now or than they were before, would make you think that Substack was a COVID blip. And we saw this with a lot of businesses, that they only really made sense during COVID because of the way the world worked during COVID. But that's not what happened. Substack was a COVID phenomenon that maintained its momentum and has only grown since. How did that happen? What is going on there? I mean, how do we explain that? Just looking back through the history of this business.
We have this story about what's happening in the world and how it could be better. And that story is not about COVID or stimulus, right? It's about the evolving media landscape and information landscape we all live in, right? These big mega trends. One version of this is I think that before the internet, when I was a kid, a real problem you could have is you could get bored. You could be sitting around and thinking, gee, I have nothing to spend my attention on right now. And if somebody could give me something free to distract me, that would be a really, really good deal. Because I'm just sitting here staring at a wall, or I could read a book or play chess with somebody or turn the TV on maybe. And then, so the early generation of the internet kind of was a land grab for all of that attention. And the bargain was, here's something that you can spend some attention on for free that is kind of fun and will stop you from being bored. And I think we solved boredom. There's no second of your life where you have to not be looking at or thinking about something interesting now if you don't want to. But that meant that now we live in a world where your attention is actually your scarcest, most valuable resource.
Yeah.
It's literally your life, right? It's literally the things that you're putting into your mind. It's how you're spending your days. It's who you're becoming. And so if there's a way that you could spend that on something that you value more and that helps you become who you want to become more, that has newly become incredibly valuable. And if there's an economic engine and a social contract and a set of technology that can unlock you to spend your limited time on this earth, paying attention to things that you actually value and becoming who you want to become. And for a creative person, if you can do the work you actually believe in, if you can make something that you think is great and make money from it, that's the real underlying value. And that story.
So it almost becomes a form of social media. And it seems that it is kind of trending in that direction. Do you think of Substack as social media?
I think it's fair to describe it that way. I think of it as what should come after social media. But I think that we are making that thing. And the Notes and the Substack app, the reason this matters is because we sort of realized at a certain point, hey, Substack is giving you as a writer or creator these tools to, connect directly with your audience and to make money and to do the thing. And that if you're somebody who already has a huge following, you can kind of, pull that audience and bring it to your Substack, and that's really good. And now you're set up in this wonderful way. But if you are somebody who aspires to do that, the most important thing is, how do you grow? How do you find an audience?
Yeah.
How do people get a chance to fall in love with you in the first place so that they realize they might want to pay? And this is why the paywall is the last thing. A lot of people who are very successful on Substack paywall very little. It's really about, hey, am I making something that actually reaches people that they find deeply valuable? And the way that it was working was that the way that writers and creators on Substack would grow is they had to go to all the other social media platforms. And that's a problem for two reasons. One is because now you're still downstream from the incentives on those platforms, right? If we're saying, hey, we want to create an alternative to the attention economy, but if you want to participate in it, you still have to be really, really good at Twitter. There's a contradiction there. And the other thing is that, those other platforms don't necessarily want you to be able to connect directly with your audience and take them with you, right? If, we got in a big spat with Elon around the launch of Notes and he briefly banned mentioning the word Substack and crushed the links. But even, Mark Zuckerberg spent 5 years mad about the sort of fallout from the Cambridge Analytica thing and sort of, heavily turned down the dial of politics on Facebook. And that's, that's a fair thing to do. But if you're a political journalist who wants to grow on Facebook, that's really tough for you. And so there's all of these other networks that creators, writers depend on. We want them to be able to use them to their maximum. But unless there's one place that actually shares their interest and makes money when they make money and believes in their success and thinks that they should own their connection to their audience, if we could create a place like that, that would add so much value.